just on the spread or the arbitrage between these numbers, you have a negative interest rate of 3.1%. You're getting paid to borrow money. Welcome to episode 1870-1870, and today our guest is the author of Woke Inc., Inside Corporate America's Social Justice Scam. I want to highly recommend this book. There are many nuances I did not understand or comprehend, and he does a fantastic job in illustrating them and talking about the censorship problem, which, as I've said many times before over the years, I think is possibly the biggest problem facing humanity. And I really mean that. It is a bigger problem than war, than pandemic, anything. Because if people cannot communicate, they cannot solve the problems. The problems will be, quote, solved, unquote, by the elite class. Hopefully you listened to my interviews with the author of Davos Man a couple of weeks ago. And that's what we'll have if we don't have a free press, as the founding fathers wanted us to have, right? The First Amendment, so incredibly important. And that press is now in the hands of tech companies. So that's where we are. But this book is really good. I'd highly recommend it. This is a 10th episode show today where we go off topic and discuss something of general interest. And this should be of interest to every human in the world. It is an incredibly important topic. It's a fantastic book, and we'll have the author here in just a moment. Vivek will be with us. But first, I want to start with what I've called many times life's most important question, and that is, of course, compared to what? Compared to what? And just in thinking about this over the weekend and thinking about the inflation trade, if you will, or the interest rate trade, or the cost of money, the time value of money, and also opportunity cost. These things aren't the same, but they are very closely related. So I wanted to just talk about that for a few minutes. We'll touch on some financial stuff here, and then we'll get to Vivek talking about his book, Woke Inc. Okay, so let's dive in. So here is the issue with many people. Of course, they've been saying this since the beginning of time. I'm going to time the market. It's too overheated. I'm going to wait until it crashes, and then I'm going to go in and buy everything and keep my powder dry, right? Keep my powder dry. They always say, got to have my cash ready. Cash on hand, because this time, unlike last time, I'm not going to miss out. In 2008, I missed out, they all say. I wasn't ready, they'll say. I didn't appreciate it, they will say, right? And of course, that's because it's impossible to know where in that curve, in that trough, or on the peak, or the valley, or the top of the mountain, where you are in the cycle. Nobody really knows. I mean, nobody really knows, not even the elites. Because the economy is so complex, the marketplace is so complex. There are billions of actors. They're acting on mostly emotion, and it's just very hard to predict which way anything is going in any market, whether it be real estate, stocks, cryptocurrencies, foreign currencies. I mean, whatever, anything, precious metals, anything you want, right? It's very difficult to understand that. So let's talk about timing the market just for a moment here. And if you're watching this on video, you see the screen, where I say, good luck timing the market, right? Say in 2022, this year, you have $100,000 sitting around. And you got this $100,000 and it's burning a hole in your pocket. You don't know what to do with it. Do you keep it in the bank? Do you stick it in the stock market? Do you buy some rental properties? Do you invest in your business? Do you buy some gold or silver or something else, right? Do you buy bonds? Right? Well, this $100,000 is in the bank and it is ready to be deployed. It's liquid cash. So it's the dry powder waiting for the market correction. Now, I cannot tell you the number of people, including many who have been on this show before. One of them is our client, Drew Baker. He won't mind if I pick him. I just remember having all of these conversations with him about how the market's too overheated. He's going to wait for it to change. And, he's been great in helping you learn about self-management and just managing your properties, managing your managers better. And of course, he's active in our formerly called Empowered Investor Inner Circle, the new name, Empowered Investor Pro. Cut out a few syllables there to make it easier. So yeah, you've heard Drew on the show many times. He's a client of ours and an old friend of mine. He was saying this in the 2015 era, 2016, 17, 18, 19. He was saying, hey, Jason, I know there's going to be a correction. I'm going to wait. I'm just going to wait for the market to crash before I buy properties. I got 10 properties now, 10 rental properties, plus my own home. I'm just going to wait, right? And here's the problem. Very few people, when they're waiting and keeping their powder dry, consider the cost of waiting, okay? They don't look at it like that. As humans, our mind just doesn't work that way. It's a strange phenomenon, but it is the way it is. So you have this $100,000 in the bank, just as a nice round number example. If it's $1 million, then add a zero. If it's 10 million, add 2 zeros. Whatever, it doesn't matter. The concept is the same. And, I say that real inflation now is easily 15%, if not 17 or 18%, because, hey, the government says it's 9.1%. So it's got to be at least, almost double that, right? That's what most experts will tell you. So 15%, let's go with that number, 15%. So the cost of waiting 1 year is $15,000. In 2023, your 100,000 will now be debased. It will shrink in value to 85,000 constant dollars or real dollars or consistent dollars. So don't just think about what you get or lose by making an investment choice. Also think about, and that would be called the opportunity cost, but also think about the for sure 100%. Well, look, nothing's 100%. I can't say that. No one can say that. But, this is just my opinion, folks. Okay. I'm just a hack here with a lot of opinions, right? A lot of you don't like my opinions, but hey, you don't have to listen. There are other shows with people who are less informed than me that you can listen to. Especially when it comes to politics. I just love these political comments I get. These low information people. We don't care about your politics. Well, if you think that money and politics are like separate issues, oh my God. Seriously? How could anybody be so delusional? Politics, the political environment, is like the air we breathe. It is the context in which we live. Almost everything comes out of the political environment. Interest rates, deficits, budgets, national debt, like everything. It all comes from the political environment. So for people that listen to the show and think, well, we don't want to hear political stuff is financial stuff. Political stuff is investing stuff. Politics is like the air. It is the context. Look, fish live in water, but they don't really think much about the water. I'm guessing. Hey, listen, I don't know. The fish I know, they've never mentioned it to me. maybe the fish say, oh yeah, they think about water all the time. But everything in their life is generated out of the water, the context. All content comes from context. And that's the political environment. It is the context from which all our content comes. Are we rich? Are we poor? The Wealth of Nations, Adam Smith, wrote that more than 200 years ago. And It all comes out of the political environment. So if you think you can separate politics from finance, really, it's just a delusional, immature idea. I mean, I don't know how people think that. I know the vast majority of you don't think that, but it's always that small minority of people who don't get it that kind of drive you crazy, right? Anyway, whatever. So you're going to lose 15% of your money by waiting, right? Okay, now here's a funny thing. In the compared to what question, we talked about negative interest rates many, many times on the show. And now CPI, the official inflation rate, 9.1%. Let's just go with the government's number. Let's just go with their number, 9.1%. Absolutely staggering. And mortgage rates, hey, they ticked down a little bit in the last week or two. So that's good news. But, let's call it 6% for nice round numbers. That means you're literally, without earning any rental income on your property, without any appreciation, without any mortgage pay down, and without any tax benefits, and without inflation-induced debt destruction, just on the spread or the arbitrage between these numbers, you have a negative interest rate of 3.1%. You're getting paid to borrow money. But wait, there's more. So let me introduce Mr. Spock. Now, Mr. Spock from Star Trek was my favorite character. For some reason, when I was a kid, growing up watching Star Trek reruns, and I was clearly a nerd, that's why I did not get the girls, okay? Mr. Spock was my favorite character. I was Mr. Spock for Halloween on more than one occasion, okay? Because I just appreciated his logic. I just thought logic was the ultimate truth. And of course, it's a big part of truth. It's not all truth. It's not the ultimate truth. When you grow up, you realize that there's a lot of shades of gray in everything in life, right? But it was easy for me to glom on to the Mr. Spock ideology because it was just cut and dry. It was simple, logical, right? So here is how illogical we are as humans. And over the last 10 years or so, I have seen so many of you listening make this trade. And, you thought it was a good trade. And I thought it was a good trade. And listen, I made the trade myself. I made the trade with you. This is the trade, right? And when I say the trade, I mean, the trade is like, you think of it as trading stocks or, trading currencies on the Forex exchange or, whatever, right? Trading commodities. What I'm saying here is you made an investment decision and it had certain characteristics. And the trade was, well, you used money to buy it and you got certain characteristics with it. Well, one characteristic you commonly got, give or take, I mean, it bounced around a bit, but let's call it 4% on your mortgage rate. A 30-year fixed rate mortgage at 4%. In June 18th of 2015, which if you're watching on the video, you see the chart here with Mr. Spock and the chart from the Fred website. On June 18th, 2015, the mortgage rate on a 30-year fixed rate mortgage was 4%. 4%. Okay, great. Well, at the exact same time, the inflation rate, the official rate by the government standards, the official rate of inflation, the CPI told us that the rate was 2.11473%. We'll call it 2.1 for round number's sake. So basically your trade was you took a 4% mortgage and you had an inflation rate where I'm only going off official rates here, right? Because the example I gave you was the official rate of inflation at 9.1% today. So the trade you made there was this, let's just round it off. Let's call it 2% inflation and 4% mortgage rate, meaning you had a positive interest rate, a cost. The net effect was that you were paying 2% interest. So that represents a loss. Now, thankfully, this is not the sole characteristic of a real estate investment because it's a beautiful multi-dimensional asset class, and we earn our return on investment in many ways. But everybody pretty much universally over the last decade thought this was a fantastic deal. And they were not wrong. They were right. I took the deal myself. Okay? I agreed with the deal. I took the deal. This was a good deal. But you were paying a positive interest rate of approximately 2%. Now, you had other benefits from the property. Of course, you had cash flow, tax benefits, mortgage pay down, your principal reduction, inflation-induced debt destruction, etc., right? All those benefits were great. But just on the arbitrage between the inflation rate and the mortgage rate, you were losing 2%. Today, you're gaining 3.1%. I mean, of course, it depends on the rate you actually end up with, and it depends on where inflation goes in the future. Now, here's a fair question. Here is a very fair question that I've been asked, and it's a good question. Unlike the political comments. Oh, gosh. Don't drive me crazy here. Whoever you are out there, if you think politics and money is not connected, oh my gosh, really, I can't help you. I really can't help you. I wish I could, but I can't. Anyway, many of you have asked, well, what if the inflation rate goes down? What happens when they get inflation under control? Well, that's a great question, and I'm going to address that a lot more in upcoming episodes. But suffice it to say that inflation will go down likely as a result of an economic contraction or a recession. Now, a recession has a sort of technical definition, and there's a committee that decides if we're in a recession or not. And, we're possibly in a recession now, although it's complicated because employment is so good. And, the academic definition usually is just, 2 quarters in a row of declining GDP. Okay, well, that's not really the whole picture. And that's why there's a committee of mysterious elite people that get to say whether or not we're in a recession, right? Whatever, that's another rabbit hole to go down. But look, as that happens, then the central planners, Jerome Powell and his, open market committee at the Federal Reserve, will make different decisions, and they will reduce interest rates. And at that time, you can refinance. And you might be saying, well, there's a cost to refinancing. Well, you're right most of the time. Now, there are no-cost refis out there at times. The market varies, where sometimes they'll pick up your cost of refi, which basically means they just build your points into the equation. They give you a higher rate. It's essentially a buy down or a buy up in that case. But, the rate could still be good, a lot better than maybe 6% that you agreed to today, or whatever you agreed to, 6.5, 6.75, I don't know, whatever you agreed to, right, depending on the loan you chose. And this is why adjustable rate mortgages really could be a very good decision right now. Not always, it depends. Talk to your investment counselor that you're working with through jasonhartman.com, or you called at 1-800-HARTMAN, US only for the phone calls. Otherwise, you got to just go see us on those internet thingies, jasonhartman.com, and they'll help you work through this and analyze it. But this is the basic deal. You take this deal that everybody took over the last 10 years, and they were happy to take it, where they're losing 2%, they're paying a positive interest rate, an interest rate cost, a cost to them of 2% to get the mortgage, or the deal we have today, which is negative in interest rate payment, a negative interest rate, but that's positive to you because you're borrowing at a negative interest rate at 3.1% in this example. So the choice is yours, of course. Do what you will, but that's how it lays out. And I hope that's helpful to you. Let's get to our guest. Let's talk to Vivek, and we're going to hear about Woke Inc. Fascinating interview, fascinating book. Here we go.